I think it's premature. I mean, maybe, stepping back and looking at the big picture, yeah, it's maybe a bubble. Yeah, I think there is a bust to follow. But if we're 40 or 50% away from um, a top in the stock market, it's a little hard to be talking about a bubble here, right? I mean, it is, we are moving into what I think will be a parabolic move. So you can gain a lot of ground in a short time. So time wise, I think we're not that far away from the top. But distance wise, the returns we could get this year between now and say election time, and probably before that, are the kind of returns that you normally have to wait 2 and 3 years to get. You have to work through several years of returns to get this, and we could get it all in 6 months or less.
And then when you look at the Russell 2000, because I think, as you said, that's probably one of the calls which there'll be most, I guess, skepticism about because it's, you know, really lagged, I guess, the other indices. And it's, if you look at the companies, I think, I don't know the exact fact, but quite a lot of them aren't actually profitable. And I think a lot of the returns are from sort of this top few companies, which isn't uncommon for indices. But why do you sort of have this thought that it's potentially going up 60%?
Yeah, there's a couple things. Obviously Russell is populated by a lot of small banks and small financial companies. So the banks got hit hard in 23, in the spring of 23, and have kind of been fighting ever since. So that hurt the Russell. We've been in an economy that has been struggling, and we had basically a rough economy in 2022 when the Fed was tightening, and 23 was kind of, slow growth. So the smaller companies have a harder time overcoming, slow economy. So that has all held the Russell back to some extent, and they're very interest rate sensitive because of that, because they are, dominated by financial companies, et cetera. And rates have been up. So all that means the Russell's being rational, I guess. But if you look at it, it's come up from its lows quite a bit, from the October lows certainly, and there's a trend line there. Every time it corrects back to what is an uptrend line. I don't see anything disturbing about what it is, except that it's lagging the larger cap indexes. So, of course, the Nasdaq led the way because of Nvidia and the so-called Magnificent Seven early this year. Some of those have slowed down, some have kept going. But this narrative that's out there that everything is the Mag 7 or everything is, a few tech stocks or everything is Nvidia is just false. You've had strength in industrial companies, a lot of strength. You've had strength in the home builders, starting to take a little gas there now, but you had strength in those. You've had strength in, copper's caught some fire. Obviously now the metals and miners are starting to pick up. So it's a myth, and even I like to look at the XBD, the broker dealer index. That's a very bullish index if you look at it. I think there's a lot of upside coming in there, including the Goldman Sachs of the world, but also the smaller investor like the Schwab customer is going to be fueling a pretty good move in those retail brokers too. So I don't, those that want to be bearish, good luck, because I when I step back and look, there's a lot of reasons to be bullish, and it's not. Yes, we've had a narrow market at times. Early this year was very narrow. It's broadened out since, but then what people do is they don't understand. So the Russell started to go, and then with this backup in rates, the Russell backed up. They forget the part where the Russell did start broadening. Russell and other stocks did start performing better, and you did have a broadening in the market. They go back to the worst case when, after a pullback in those indexes or in a lot of those stocks, and say, see, the breath isn't any better. Well, it is better. It's a stair-step process. So, there's a lot more to this market than just NVIDIA or just, the Mag 7s. And it's going to get broader as it moves towards the top, which is what I've said for a while. When I look below the surface, there's a lot of things to be bullish about, not bearish.
Okay, that's really interesting. And but before you were talking about how I guess a lot of the institutions are, they're reluctantly bullish. Do you think that's why we're seeing precious metals increasing as well? Are they the ones sort of going in to try and hedge themselves against the equity risk, or do you see that as being other drivers?
Yeah, because they've been so slow to break out. I mean, they were, as you know, they were a disappointing group for years. Gold, gold itself was, made basically made an effort to break out to all-time highs 3 or 4 different times over the course of a couple of years. So gold was up near its highs. Silver was lagging a lot, and the miners were lagging a lot. The fact that they're moving now, I don't think has a lot to do with the broader equity market. I think it's really um, part of it is maybe the tensions around the world. Part of it, I think, is that gold did break out finally, and silver's starting to follow. So I think it's giving more encouragement to something that didn't look like it was going to happen. And again, just like so much of the market, it's momentum. Once they get above certain resistance levels, they attract more interest, and that begets more interest. So I think we're early on in a very big move coming. I've said before, I think gold can get 3,000 this year, pre-bust. I think silver can get to 60. These are long held targets, and I've said of late, if it breaks above 60, I think it could get to 75 very quickly. So silver, my target range is 60 to 75, and gold it's 3,000. And I've said I would not be surprised if that 3,000 proves conservative. And the miners, I mean, I think they've got certainly doubles from here, and some of them even triples from here, pre-bust, which is basically this year. So there's a lot there that wasn't there, just 6 months ago. They've really caught fire.
Yeah, it does seem to be a sort of an everything bubble, and assuming that bonds, the yields go down as well as you're saying, then we'll have bonds sort of increasing as well. So it's going to be almost every asset increasing at the same time. Are they correlated? I guess the bonds and equity, but then you said precious metals is uncorrelated, or yeah, how do you see that?
I think they have their own. Yeah, I mean, with the market, obviously, as they gain momentum, they'll be part of the market. And I think institutions own so little of the precious metals, and that group is such a small capitalization that if institutions ever decide they need to have 5% of that in their portfolio, you can run these things up just on a supply demand basis for the stocks. So, and that's what I think is going to happen. It doesn't take much when you're in such a small, thin group. When nobody wants them, yeah, they can kind of wallow around in the bottom. But once they break above some levels and institutions take notice, it's look out. And in terms of everyday bubble, I hear that a lot. I think it's premature. I mean, maybe stepping back and looking at the big picture, yeah, it's maybe a bubble. Yeah, I think there is a bust to follow. But if we're 40 or 50% away from a top in the stock market, it's a little hard to be talking about a bubble here, right? I mean, it is we are moving into what I think will be a parabolic move. So you can gain a lot of ground in a short time. So time wise, I think we're not that far away from the top. But distance wise, the returns we could get this year between now and say election time, and probably before that, are the kind of returns that you normally have to wait 2 and 3 years to get. You have to work through several years of returns to get this, and we could get it all in 6 months or less. I think mostly it'll be all boats go up, but I think the financials are going to gain momentum here. As I said, the broker dealer group looks good. Banks, I think, will do well, and probably the larger ones better than the regionals, but the regionals will have a catch-up rally here, I think. I think the industrials still look very good and can continue to lead. Semiconductors, which has been my highlighted group all the way through since I turned bullish or started talking about this move 20 months ago. As far as they've moved, they still look good. I have a target of 300 on the SMH. And I know that's going to have to be raised, whether it's 350 or 400, I don't know, but I think that's the kind of upside you still have. And, the consumer isn't the place I would probably focus, but I think even consumer discretionary is going to have, some room to run. I think steels can run. I think copper has a big run ahead of it. There's just so many places. A lot of the commodity area probably will have a run here. So what could surprise, we got everybody, we had everybody in the early this year assuming the Fed was going to be cutting well before now, or certainly by now. And now we got everybody assuming, maybe we're going to get one cut this year, maybe no cuts this year, I think the surprise could be that things start slowing here in the summer, between June and August, and the Fed comes back, and the expectations come back around to cuts, where the Fed says, yeah, we can't just ignore the fact that the jobs picture is starting to deteriorate, bank loan picture is starting to deteriorate, et cetera. And inflation looks okay. So I think we the traders move the expectations around, and the Fed kind of goes with the traders oftentimes. But what we forget is what looks like an entrenched viewpoint by the Fed or an entrenched viewpoint by the market can flip on a dime if you get a few numbers going the other way. And so I can't say for sure that that's going to happen, but I think that's a wild card out there for sure, is that we might be right back in cutting mode here soon, or expectations of cuts. Certainly, if Taiwan were invaded, if China decides this is the time, it's going to hit the markets. I'm not blind to that. But I think the likelihood that China chooses 2024 as a time to do that doesn't make a lot of sense when they've got a lot of problems on their hands already. I mean, do they need to alienate their biggest end market? And certainly the two biggest end markets, Europe and the U.S., U.S. being largest. I don't think so. If we see it always from our side and from a concerned viewpoint, we always expect the worst out of them and things, but they're pretty rational, I think, for self-serving rational. And I think they got their hands full. Their real estate market is a mess. Their pension system is a mess. Their economy, they don't have an easy solution to jumpstart their economy again. They're faltering, and they got a huge population to satisfy. So maybe they use that to distract, but I would think that that's a risky. They're typically more a risk-averse population or a risk-averse government. I would think they'd say this isn't our strongest time to be doing this. So, yeah, I'm pessimistic about what our country is doing right now politically or how it's being led, but I don't think China's looking for a battle right now. And so my guess is it's a low probability event for this year. And as a result, I don't really factor it into my work. I just know that if it happens, I'm going to have to reverse myself to some extent. But I don't think that's likely.
Okay. And are you factoring the, issues of the US election or just the US election in general?
Yeah, surprisingly, elections usually have a big impact on, markets in the election year. My forecast is not really using election as much of a factor. As big a difference as Trump and Biden are policy wise, I don't think it makes a difference for the short run. Meaning, I think we get a melt up no matter who ends up winning the election. We get a melt up prior to that. I think we get a global bust after the election, no matter who wins. So I don't think that is a big deal. I know people think the Fed is probably trying to support Biden, or that's means you're going to get some pump priming, etc. Frankly, I take Powell at his word. They're trying to be as apolitical as they can be. They're focused on, they're in a tough place. They don't want to take this thing over the cliff, but they want to defeat inflation to the best ability they can. And so I think they're focused on their mandates, and not the election. Does that mean they're totally unawares, or that they don't hear from Yellen or other things? No, of course. I mean, reality is that there's some of that, but I don't think you're seeing policies being driven by the election.
Okay, makes sense. So, David, thanks so much for your time today. Really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Yeah, I guess the biggest message is that there's a big runway. Time wise, there may not be a lot of time left to this, what I call a 42-year secular bull market. It started in August of 1982, so we're approaching the 42nd year anniversary. So time wise, there may not be a lot of time left, less than 6 months, possibly. But from a distance, like I said, anywhere from 35 to 65% upside, depending on the index. That's a long ways away, distance, return wise. So people should not, I like to say on Twitter, ignore the noise. There's a lot of chatter out there trying to convince people that the risks are high and scaring the bejesus out of people. My convictions are high that there's still a good bull run ahead of us, pretty long one. So in terms of returns, so that would be my takeaway, I think.